Silicon Valley in California, which is the center of the universe, certainly the center of the money-making universe. Okay, just a second here. Let me get this set up. Okay. And if you have any questions, just put them in the chat box on the right, and I will try and get to them at the end of the webinar. So let me give you the long-term view first. The global economy is being fundamentally remade by artificial intelligence, and those companies in the forefront, like the Magnificent Seven, minus Tesla, will deliver the best investment performance. Never underestimate the earnings power of U.S. tech companies. Notice how well big tech led the last rally. After the current correction, they will lead every new rally from here on. And this current correction could last from days to either weeks. But by the middle of October at the latest, I think we will be back on a tear to new highs by the end of the year. Trade wars, inflation, recession, politics, and an exploding national debt are just temporary distractions. And to that, you can add a government shutdown on Wednesday. Keep focused on the big picture. So take out your pen and paper to take notes or start typing into your smartphone. What I'm about to tell you will blow you away and change your life, for I am in the early retirement business, your early retirement. Learn what to buy, when to buy it, and why. So, how would you like to trade for a living full time like I do? Well, listen to me, John Thomas, 55 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo and later the White House, 10 years running the international equity division at Morgan Stanley, Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, 17 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders in the modern hedge fund industry who's still living and breathing. Of course, 51.30% average annualized return for 18 years versus 28.1% for the S&P 500. That's us in the blue. That's the S&P 500 in the orange. We are outperforming the index by about 2 to 1. But don't listen to me, listen to one of my happy followers who's made a fortune.
Hi, my name's Wilson, and I've been with the Mad Hedge Fund Trader, John Thomas, since 2019. I caught the phenomenal returns in 2019 and 2020, somewhere in the order of the 80–90% returns on both of those years. I caught all of those trades, NVIDIA, the TLT, the Teslas, and so many more. And then in 2021, I started trading in some additional accounts, and I have caught almost all of those trades as well, and have been getting almost the entire returns that John has received, and it's been just fantastic.
All right. Well, thank you, Wilson. And how did Wilson make this money? Well, he got a 482% return on NVIDIA, another 811% on NVIDIA, 421% on Berkshire Hathaway, 412% on JP Morgan, 394% on Palo Alto Networks, 350% on Vertex Pharmaceutical, 113% on silver, and again, 87% on JP Morgan. And notice these returns are far, far higher than what the underlying stocks did. And one of the things we can teach you is how to use option strategies to minimize your risk and maximize your returns. This is our secret weapon, the Mad Hedge Profit Predictor. It's a market timing index which is an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. It took a team of mathematicians 1,000 hours of calculations to create this algorithm. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than a human can. Imagine a trading strategy that upgrades itself 8,000 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. And this is 3 years of our market timing index. You get a lot of buys at market bottoms, sells at market tops, buy, sell, buy, sell. It's a real money-making machine. I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. Uh, and this is our market timing index for the last 12 months. Notice that we have a nice head and shoulders top setting up here. Shoulder here, head, lower shoulder here. My bet is that the next move will be into a October correction down here, and then we go back up to the highs again for the new year. So why do I cover all asset classes? Sounds like a lot of work to me. Um, Information about one asset class sheds light on all the others. For example, knowing what the bond market is going to do and therefore interest rates is incredibly useful advantage when picking stocks. Some asset classes will be doing great while others are dead in the water. It will point you to where to trade the winners and how to avoid the losers. Give yourself every advantage. Know what's happening all the time, everywhere. So what happens when the euphoria wears off? It has to happen sooner or later. That means it's time to become a bear market expert. There are many different ways to play the downside in the stock market. I'll start with the simple ones and work my way up from there. So, of course, the most commonly used one is the SDS, and that is a 2x short S&P 500 ETF. That means that every time the uh, S&P 500 goes down 10%, the SDS will go up 20%. And of course, that's exactly what it did in February. We started out here at 17, went up to 28, and then collapsed from 28 all the way back down to 14. So yeah, the tracking is actually fairly close, very liquid, and very cheap to trade. So this is a classic hedge that a lot of hedge fund managers use. And if a 2x short isn't good enough, there's also a 3x, the SPXU. Um, and again, this went from 19 all the way up to 38 during the April crash, and then gave it all back to new lows here. Hint, hint, this is a great entry point right here, right now. Even if you just get a small move up, that can still be 25 or 30%. You can also sell call options on your existing positions, otherwise known as a buy right. And in this particular case, if we sold short the Tesla 370 calls, you could have gotten $38 for those, or 10% of the underlying of Tesla stock. You would have collected $1,000 for each option, um, as long as the stock stayed below 370. And let me take a quick look. Let's see where Tesla is today. And let's see. Mhm. All right. And you would have collected um, $38 on this particular trade. Uh, You can also buy the volatility index, otherwise known as the VIX. VIX was down to 16 yesterday, um, and it was at 16 in February. If you had bought it then, it rallied all the way up to 60 or about a 400% gain. We sold it at the top or went short 60, which is a really good idea. That would have gone from 60 all the way down to 16. So again, buying the volatility index or selling it is a really good idea. Um, IPO. It turns out that IPOs or recent initial public offerings are a terrible performer in down markets. And you can see this during the February crash. There is an ETF for this with the convenient ticker symbol of IPO. It fell from 48 all the way down to 31. So that's about a 35% decline. And then it bounced back just as hard, made it all the way back up to 51 from 38. So that's a 60% gain on the long side. So again, shorting IPOs, good strategy in down markets. And you can also sell short momentum. Momentum also collapses in down markets. You can see in February, it went from 230 down to 170. Again, about a 20% decline, and then it bounced back just as hard. So the ETF for this is the MTUM. And you can just sell short beta. Beta also declines, or the rate of change of individual stocks. And like everything else in the world, there's an ETF for this, the SPHB. And in the spring meltdown, beta collapsed from uh, 95 down to 65 or even 60, and then doubled almost from 60 back up to 108. So again, the SPHB is another way to play down markets. Or you could just buy a hedge fund, and you can do this by buying the HDGE. And in this particular case, the HDGE shot up from in February from 15 all the way up to 20, collapsed back down again to 15, and now is a great entry point for this particular hedge fund. When all else fails, you can just go into cash, but there's cash and then there's cash. And you can buy 90-day T-bills. This has a government guaranteed principal, endless liquidity, trades like water, 100% collateral value for margin, lock-in guaranteed income, lets you sleep at night, can be sold any day, and you earn interest all the way up until the day you sell it. Will survive any bear market. Ask your broker how to buy it because normal stock traders don't know how to trade in the bond market. Up until 3 weeks ago, 90-day T-bills were yielding 4.3%. A lot of people were happy just to take the 4.3 and forget the volatility this year. It is now down to 3.9% thanks to the Fed rate cut. T-bills not only are now discounting the last rate cut, but the next one as well at 3.9. So 100% probability that there will be at least one more rate cut this year. So stocks, you want to buy this current dip wherever it is. Uh, is the AI bull market over? Goldman Sachs put out a report a couple of weeks ago warning investors that the AI trade could cool off from here. Oracle soared by 23% on spectacular uh, cloud growth, making Larry Ellison the richest man in the world for a few minutes. I wouldn't touch the stock up here. Oracle has $100 billion in debt. And it just shows how crazy the market is by creating $100 billion in equity for a company that has $100 billion in debt. Makes no sense whatsoever. Robinhood joined the S&P 500 finally. Um, it's a great play on millennial traders and market volume. Their entry into the index was delayed uh, because of its close association with crypto. So I'd be buying Hood on dips from here. Health and Human Services have been bad-mouthing Tylenol, slaughtering the stock there, KVUE, and that is the Johnson and Johnson spinoff that makes and sells Tylenol. Broadcom scored the biggest chip order in history, 10 billion worth from one of the large language models. Kraft Heinz split up, so you're going to have to go to different companies from now on to buy your mustard and your ketchup. And Marvell Shells, the AI chip company, dove 16% on this account, disappointing guidance. So let's look at some of the leading stocks that we've been recommending all year. JP Morgan is the quality play in the banking sector, huge beneficiary from falling interest rates, which could go on for another year. Also, a big beneficiary from uh, a deregulation, which cost them billions of dollars a year. Citigroup, another big winner. We're looking for $130 a share next year. And by the way, you can see the buy and sell signals that we got from our market timing index in these little blue boxes. Berkshire Hathaway sold off 20% on Warren Buffett's retirement announcement, now bouncing back. We're looking for 500 for Berkshire next year. And Goldman Sachs, also a double win, deregulation and antitrust ending, and a huge recovering mergers and acquisition business. We're looking for $800 a share next year. Morgan Stanley, the same, looking for $200 a share there. Another big deregulation winner. And BlackRock, um, their fees go up as the market rises. So this year we had a 10% move up in the market. That means an automatic 10% increase in fees. Plus, they have new money coming in anyway, so you get a hockey stick effect there. The previous 2 years, they made 20% a year increase in assets. So that made it a total no-brainer. We're targeting $1,500 a share next year for BlackRock. And Interactive Brokers, big option player for professionals. We're looking for $100 a share next year. Second half of the barbell are technology plays. Technology stocks always come back. AI innovation is still the leader and is growing exponentially. AI is enabling tech companies to shed jobs and overhead at a record rate, and profits to explode. Makes a great counterweight to deregulation and interest rate plays. We could spend the next 2 years rotating back and forth between these two groups. So NASDAQ, of course, is a big winner. We're looking for 25,000 in the index sometime next year. Tesla, we think will sell off some more because their car sales have been terrible, but people have great faith in Elon Musk on his robotics plays, and that will take the stock up 10 times in the next 10 years to 4,600. So definitely buy the bigger dip on Tesla. And Microsoft, again, a major AI leader. We're looking for 500 a share there. Meta has all the social media posts you've ever posted. So we're looking for $1,000 a share there. And Amazon knows everything you bought or just thought about buying for the last 25 years. We think they hit 300 a share next year. And NVIDIA has a lock on the high-end chip market, and growing exponentially. We see a minimum of 220 a share next year. Alphabet knows everything you search for over the last 25 years, and their antitrust risk just got eliminated through a settlement with the government. So, again, looking for 300 a share in Alphabet. And Palo Alto Networks, hacking never goes out of style, and they took over CyberArk to increase their market share. That makes them worth at least $300 a share next year. So bond market, you talk to any bond trader uh, these days, and he thinks the end of the world is at hand. U.S. yield curve is steepening. Uh, the U.S. Treasury yield curve, a crucial barometer of how the economy is doing, has steepened on fears of mounting public debt, uh, the president's attempts to exert control over the Federal Reserve, and aggressive tariff policies. The shift has direct implication for bank earnings. It also shapes their lending decisions since banks borrow short term and lend long term, relying on the spread. That is bad news for the economy and the stock market. It's coming down the road, but not yet. In the meantime, bond yields aren't moving, even with the Fed rate cut. So here is the TLT, which is the long bond ETF. After the initial pop going into the rate cut, it has since sold off substantially. And I don't want to touch the bond market right here. Here is the yield. We went from 5.5% down to 4%, and have since rallied back up to 4.2%. So again, bonds aren't really participating in the Fed rate cut story. Foreign currencies are flatlining with the Fed move. Foreign currencies have stalled. The only Australian dollar has seen nice gains. We may see another 20% move down as the Fed keeps increasing their interest rate cuts. With the dollar down 15% against the euro, this effectively doubles imported inflation in the US to a 30% annual rate, sending prices through the roof and demolishing the US economy. Next dollar weakness will come with evidence of recession. You want to buy all of the foreign currency plays, and I'll go through them one by one. There's the Australian dollar, uh, the Japanese yen. Uh, the euro has been one of the strongest all year against the dollar. It is the ETF has rallied from 94 to 108. British pound also very strong. It's hard to imagine the British currency stronger than the US dollar, but when you cut interest rates on a currency, it inevitably falls. Energy and commodities are bouncing along a bottom, again, because of recession fears and an OPEC market share war. Ukrainian drone attack on Russian port suspends loading there and has cut Russian exports, so brought a little bit of price relief. Um, the drone attack on Russia's port of Primorsk was the country's largest oil export terminal. Uh, Money is starting to move out into the energy play as one of the few laggards in this market. So things like Exxon and Occidental Petroleum are starting to rally. Nuclear plays are hot as ever. The grid has to triple in size in order to accommodate existing AI demands on the system. Okay, this is the long-term view of oil. I think we go from a high of $120 a barrel in 2022 down to maybe $10 as it is gradually replaced by alternatives. And notice that alternative investment continues unabated, even though almost all U.S. government subsidies have been eliminated. Comico is a great way to play the nuclear area. It's the largest uranium producer in the world. And Microsoft reopening 3 Mile Island and the other big tech companies also moving into new nuclear will be a major incentive for this stock. Precious metals, we've been hugely bullish all year and it has worked. Gold is up over 40% this year, making it the second performing asset class after the Magnificent Seven. Gold topped its 1980 inflation adjusted high. It has surged about 5% this month, hitting an all-time high, 3,674 an ounce. Uh, Gold has set 30 nominal records so far this year, 30 new all-time highs. Spot price of gold eclipsed its inflation-adjusted peak set last in 1980. Gold's rally has been driven by growing anxiety about the U.S. economic trajectory, attacks on the Fed, with investors seeking hedges against inflation and rising prices and weakening currency. Um, and we expect it to go eventually to $5,000 an ounce. So here is the chart for gold. Tremendous run for the GLD, and we're still buying the dips, looking for 5,000 an ounce in 2028. And if I'm wrong, it'll hit it next year in 2026. Here's the GDX, the gold miners ETF. That is going up even faster than gold. Barrick Gold, the world's largest gold miner, tremendous upside move here, practically doubled from the February lows. And Newmont Mining, the same, another great returns here. Silver, if you like gold, you'll like even silver more because it goes up faster, roughly 2 to 1 against gold. I expect silver to hit $50 an ounce sometime this year. Uh, and what else is there? Silver miners also accelerating at a tremendous rate by the dip. Wheat and precious metals, that's our favorite royalty streaming play on silver and gold. And this thing has gone up about 400% since we recommended it several years ago. The harsh truth is, you really need my help. The majority of individual traders lose money. They lack the correct uh, training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why did dead people do so well? Because they never sell. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10 times return on the great ones, but get wiped out by the losers. Let a 20-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. This is our trailing 12-month performance, 92.91%. And you can see we've gone up almost every day this year, except for dips during the April meltdown. We lost about 5% here, and we had a few other dips here. But, basically we're sideways up, sideways up. Richard made millions religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast. Greg turned $100,000 into $3 million solely on my trade alerts. He now bought a new home in Orange County, California, with Tesla solar panels, Tesla Model 3, and still had enough money to send 3 kids to college. Uh, see, just taking a look at this. Okay, and let's hear about my friend Bob, who turned 500,000 into 27.3 million in just 2 years.
Hi, this is Bob. I live near Denver, Colorado, and I'm hiking on top of the Continental Divide. 9 months ago, I joined John's Global Dispatch Service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it is 100% paid for it, and I couldn't be happier. Life is good. John really helps. The other day, I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
All right, Bob, thank you very much. Okay, so what do we do about this? Well, stocks, you want to sell rallies for the short term, buy the dips on the long term. Bonds, you want to buy the big dips because the Fed is cutting interest rates. Don't fight the Fed. Commodities buy dips, energy stand aside, currencies buy dips, precious metals buy dips. So if you're not up 92.91% in the past 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. 51.30% average annualized return versus 28.1 for the S&P 500. You get those kind of returns, you get to do things that other people can't do, like take the owner's suite on the Queen Mary from New York to England. And when you get to England, you can take the Orient Express to Venice for a great weekend of Italian food. This is the very long-term view, and this is where the big money will be made. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That'll create an economic boom that will last another decade that's starting in 2023. And this is not the first time this has happened. The last time we had an identical demographic setup, the Dow went up 20 times in 18 years. Are you ready for a replay? Remember those Dow 10,000 hats? Well, it's about to happen again, except this time it's going to be Dow 120,000. If you get the same performance that we got back then, that'll take the Dow up 20 times from the 2009 bottom to 120,000 by 2030. And you think I'm crazy? We're already three-quarters of the way there. You know, on a relative basis with the Dow at 45,000, we only have one more triple to go to get to that 120,000 figure. Except this time it's different. We have the AI tech turbocharger. Tech is hyper accelerating on all fronts simultaneously, and the pandemic greatly sped up the rate of change. AI based products and services are just starting to roll out. Development of functional quantum computers means that computational ability is about to increase a trillion-fold at no cost. World's major computational challenges will be solved. Barbell stocks will dominate in this scenario and will account for the bulk of stock market gains in our lifetimes. 90s had cheaper computers, cheap operating software, and a new internet. The 2020s will have this number of new technologies times 10. So who'll show you how to play the next 90,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top performing trade mentoring service in the industry, up 92.91% in a year. Follow my research and market beating trade alert, and you will rake the profits in. Let a Marine combat pilot steer you into big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, precious metals, commodities, and real estate. And that is a 1932 de Havilland Tiger Moth, which I fly whenever I go to England. This is a typical month for us. We had 10 out of 11 trades make money. You can see we made 16% on the S&P 500. We sold short treasuries, made 8.6%, bought the Russell, bought Amazon, bought Apple. Oops, stopped out of Biogen for a 21% loss. We stop out of losers very quickly. It's easier to dig yourself out of a small hole than a big one. And you can see every other trade that month we made money on. It's just a matter of time before barbell stocks break out and go to new all-time highs. Watch this space melt up going into the second half of 2025. Get ready to start reeling in those whoppers with Global Trading Dispatch as your guide. This is how it works. Our algorithm identified an imminent breakout in NVIDIA stock nearly 2 years ago. So we sent out a buy alert, which looks like this. And these are pre-split prices at NVIDIA. It says buy NVIDIA at 480 or best. And in this particular trade, you had to buy 21 shares to get a $10,000 exposure. What happened? Well, NVIDIA went up 45% in 22 days. So we sent out a sell alert, judging that it was short-term overbought. And that looks like this. Take profits at 695 or best. And in this particular trade, we made $4,500 on a $10,000 investment in just 22 days. So these are our 10 bankers, stocks that went up over 10 times after we recommended them. There is Zoom, which went up 10 times from our initial cost. Lam Research went up 10.6 times. Square went up 25 times. Moderna went up 40 times. NVIDIA up 70 times. And Tesla, the big daddy of them all, went up 178 times from our $2.50 cost. Living here and working in Silicon Valley, you'll get in on the big winners early. And that is our added value to this game. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income. Go from complete beginner to seasoned pro in weeks. Learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. And that is me sending out a trade alert from the coast of North Africa. And I'm trying as hard as I can to smile because it is 120 degrees there. With my Mad Hedge Global Trading Dispatch service, you get instant trade alerts sent out at market sweet spots, about 200 a year. And I just sent one out this morning. All the reasons to execute them, live bi-weekly strategy webinars with an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, more educational videos and webinars than you could consume in a lifetime, access to a 16-year data of a surfing camp in North Africa. Warning, it's harder than it looks. Okay, this is the one-stop shop. It's for individuals who want to understand what is happening with their retirement funds. It's for people who want to learn how to trade for a living, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in before the next melt-up begins. This is what you get. You get the global market comments in your inbox every morning, 5 days a week. And you get Mad Hedge hot tips, the 5 most important things that happened today and what to do about them. Here's what I'm not going to charge you. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge $12,000. That's what I charge my concierge clients who get my personal cell phone number. And I'm not going to charge $3,500. That's the full price of what I'm offering you on my website. This is the real deal. Uh, Creating this product cost me millions of dollars. With the best customer service in the industry running it cost me millions more. 6 months for just $997. That's a 71.5% discount to our website price. It's a limited time offer. We only take 25 new subscribers at a time, so it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the link on the chat box on the right, and David has very kindly put it in there. madhedgefundtrader.com/0925. Let me make the money for you to pay for your own subscription. You make the trades. Discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Click on the chat box on the right. And just to give you a tease, if you subscribe now, I will immediately send out a trade alert that you can execute instantly because the market is still open. What I'm not going to tell you is that this is a buy or a sell. So you'll have to subscribe to find out. And also, if you sign up today, you will get my free video course, Options Trading for Beginners, a 12-chapter course about everything you ever wanted to know about options, written for the basic beginner. So if you're going to work with me for the next 6 months, it's best to find out who I am. I grew up in a remote farm in Southern California, oldest of 7 children, had the classic American childhood, playing Little League baseball and becoming an Eagle Scout. Wasn't much to do in the old days in California, but hunting, so I picked up a job as a paper boy for the Los Angeles Herald-Examiner. I found the stock pages, bought IBM at 20, sold it at 30, and suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to go to Europe. By the age of 17, I'd visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see a future in that, so the government sent me to Southeast Asia for a few years of research missions where I learned to jump out of and fly perfectly good airplanes. There I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. And all I ended up with after 10 years of government service was this box of medals, which I trot out once a year on Veterans Day. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. I figured out very quickly you didn't have to be that smart to make money in the stock market, so I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund, and this is my original ID card from Morgan Stanley from 1983. Yes, the years have been cruel. I served as a tank commander in Desert Storm in 1991. We lost 1 tank and the Iraqis lost 5,000. As you can see, I like winning. I rapidly became the top performing hedge fund of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it has a big impact on your lifestyle. You get to buy the latest hot car, fly your own private plane around Europe, go marlin fishing in Mexico, and collect vintage Rolls Royces. I now spend my days pursuing my first love, finding winning trade alerts. But now I do it from my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There's far more satisfaction playing, leveling the playing field for the average guy and teaching him how to trade, and that includes you. If I can take a $50,000 account and turn it into 500,000, that is more job satisfaction than I could ever get anywhere. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. If you see old planes flying loops over San Francisco these days, it's probably me. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans, and I'm a major donor to wounded warriors. When wildfires hit California, I visited the main evacuation centers and handed out $10,000 worth of Target gift cards. Okay. All right. So now it's time to go flying. Oops. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. So it was in that spirit that I traveled to the famed World War II fighter station at Biggin Hill in England to meet Mad Hedge concierge member Peter Monk. Peter was a poorly paid pilot for Ryanair when he first signed up for my global trading dispatch. After doubling his money in the first year, Peter upgraded to my concierge service. Then the money really started to pour in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain veteran, the Supermarine Spitfire Mark IX, in his backyard, begging, borrowing, and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which today are worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild and blustery day when we took off and headed for the English Channel. Even though the plane was 82 years old, we managed a brisk 250 miles per hour over the countryside. The Spitfire outmaneuvered any plane that the German Air Force threw up against it. This particular plane is credited with shooting down two Messerschmitt 109s, and it's easy to see how. We found a clear piece of sky over the white cliffs of Dover, between two big fluffy cumulus clouds, and I commenced a full-on aerobatic flight test. Peter always wants to see what I can do in these old planes, and this time was no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wingovers, careful never to exceed 1G limitation or the wings might fall off. Spitfires can dive like crazy. We dropped from 8,000 to 2,000 feet in seconds. Then it was back to Biggin Hill for a perfect three-point landing and a pint of beer. Let me make millions of dollars for you as well, as I have done for thousands of others over the last 18 years. I look forward to working with all of you. And let me check my store, take a look, and see how many sales we've got. Let me take a look. And we have, just a second, I'm opening the store now. Drum roll, please. Um, da, 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 okay. Okay, we have Karen from Cody, Wyoming. Thank you very much, Karen. Please look in your inbox. You should have the trade alert by now. Thank you very much, and I promise to work hard for your money. We have John from Douglas, Georgia. Thank you, John. If you don't have the trade alert, look in your spam folder, and that is sometimes where it goes if you're a brand new subscriber. We've got Frank from Columbus, Iowa. Thank you very much, Frank, and uh, look forward to working with you for the next 6 months. We have a Peter from Shreveport, Louisiana. And let's see. Let's check this mailbox in here. Yeah, I got another 4 orders. Okay, so we have um we have Zenek from the Czech Republic. Sorry, Zenek, if I mangled your name. Check the inbox for your trade alert and execute it right now. It's a good time to do it. And we have another one here. Okay, we have Jonathan from Annandale, New Jersey. Jonathan, thank you very much. Check your inbox for the trade alert. And another one here is da, 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 da. Jeff from Plattsburgh, New York. I think they had an Olympics there once. Um, and a Judy from Memphis, Tennessee. Okay, we're running short on time now. Let me see if there are any questions. And uh, David, if you have any questions at your end, go ahead and shoot. And I'll scroll through the chat box. Here's a question. Do you think the government shutdown on Wednesday will affect the stock market? And the answer is only a little bit. We may sell off going into the Wednesday shutdown. The market was way overbought anyway and begging for a correction. So we really need one so we can get back in to our positions that we've already taken profits on. The market doesn't seem too worried about it today, down 223. Um, so, and somehow the government always seems to reopen. How about that? So, um, I think short term, yes, long term or medium term, it'll have no effect. Uh, Once people figured out that the shutdown stops the money flow out of Washington into the rest of the country, they figured out how to get it reopened pretty quickly. Okay, let's see. Any other questions? Um, okay, here's another one. How far do you think the dollar could drop from here if the Fed keeps cutting? And I would say we've dropped about 20% from the highs this year. I think we could drop another 20%, especially if the US dollar becomes one of the lowest yielding currencies in the world. Right now, it is one of the highest yielding. Okay, let's see. Thoughts on crypto? Someone is asking. Answer. Uh, it is a totally liquidity and sentiment driven instrument. And as long as assets are pouring into the market, crypto will go up. Um, I don't think we'll hit the $1 million target, uh, but it would be easy to revisit the new highs at 122,000. So, um, I think people do crypto because they don't know what to do in the stock market. I know what to do in the stock market, so I don't bother with crypto. I do trade MSTR very heavily because it is one of the most volatile stocks in the market. This is a crypto treasury stock, um, which borrows money at 10% to invest in crypto which yield zero, but as long as crypto goes up, they're okay. So I tend to buy the big sell-offs, which we're having now. We are approximately 40% down from the recent high. And I tend to sell the big rallies because the implied volatility on the options is anywhere from 50 to 100%. Okay, well, I'm just about out of time, David. If you want to take it back, that's fine with me.